So in this video, I'm going to go through the solution to question 16, agricultural relief, including non-agricultural assets. So this introduces a particular concern or issue which we need to deal with. The person is receiving a mix of assets, some of which qualify for agricultural relief and others which don't. And we'll just have a look at the details to get a sense of this. So Tim transfers the fund assets to his daughter-in-law Kate in July 2019. So there's farmland, farm buildings, woodland, livestock, bloodstock, farm machinery, all of which are agricultural. But this asset here, the holiday cottage, that's going to be treated differently. That's not an agricultural asset. So of the total being transferred, one item is not agricultural. Now, it would be a relatively straightforward calculation if there were no costs associated with the transfer, but the issue that arises is there are some costs on the transfer and we need to split those total costs between the proportion relating to agricultural and the proportion relating to non-agricultural. So the farmland is mortgaged for 80,000, so that's totally linked to the agricultural element. That's not a shared liability. Kate has agreed to pay William, Tim's youngest son, 300,000 in consideration of the transfer. So this does need to be split between the proportion of the 300,000 attaching to the agricultural element of the benefit and the proportion attaching to the non-agricultural element. So in the solution that follows, you're going to see some calculations in relation to that 300,000, which is something we didn't have to deal with in earlier agricultural relief questions. Legal and other costs associated with the transfer amounted to 20,000. Okay, so this again is the same general point. These are associated with the overall transfer, and we therefore have to split the 20,000 euros between the proportion relating to the agricultural assets and the proportion relating to other assets. Kate's husband Vincent, Tim's eldest son, had died 12 months previously. So again, that establishes the daughter-in-law link between Tim and Kate. But there's also a very important consequence there that's worth noting, and we'll see that in the solution. This is known as stepping into the shoes of a deceased person. And it essentially benefits you in terms of the group threshold that you can apply, but we'll see that in the solution. Kate's other assets are her principal private residence worth 270,000, mortgage outstanding of 60, car worth 18, car loan outstanding of 3, and a bank deposit account of 2,000. So this is going to be used for the assets test. You should recall that with agricultural relief you need to meet both an assets test and a working time test. So in the early part of our solution we will do the assets test. Kate and William have not received any previous benefits. Okay, so that means when you're doing the aggregation process, there are no prior benefits. And you may assume that Kate intends to lease the farm assets to a qualified farmer on receipt of the benefits. So that covers the working time test. Kate herself isn't maybe qualified as a farmer for the purpose of working time. She may work in an office job, but if she leases these farm assets to a qualified farmer, she meets the requirement for working time. So we're going to look at the solution. Now the requirement is complete the CAT payable by Kate and William, if any of the above transactions. You may ignore the credit for CGT. I'm actually going to focus only on Kate. I don't want to look at the situation for William, so you can assume that the issue that is presented in the solution regarding William won't be an examinable topic. So I'm going to switch to the solution now and we'll go through that. Okay, so first thing I do is determine if Kate qualifies as a farmer, and this is the assets test. So we have to list all of her assets out and categorize them between agricultural and total. So I'll just see, can I squeeze the page, the Word document into this? Okay, so we list all our assets, including the ones that she already owns. So we categorize them as agricultural or other. So that's done here. And You can see that the farmland, the buildings, the woodland, livestock and farm machinery, they're all classed as agricultural. The holiday cottage is non-agricultural. And again, a couple of points worth noting. The principal private residence goes in net of the mortgage, okay, whereas the car goes in gross. You don't deduct the car loan from the value of the car. So the €60,000 mortgage was deducted off her house worth 270, so that gave 210. But the car worth 18 with a loan outstanding of 3, it went in as 18. Okay, so again, that's a point worth noting. And in terms of the agricultural assets, they're all shown gross, so we don't deduct any liabilities that attach to any of the assets at this point in time. Okay, so again, remember that the outcome or the effect of all of these deductions or non-deductions is beneficial to Kate. We're trying to ensure that her agricultural assets get to 80%. So by reducing non-agricultural assets, it does help, and by not reducing the agricultural assets, it also helps. Okay, the car not being deducted is obviously not going to help her, but the deduction for mortgage on her PPR is significant. So the calculation comes in as 160 out of 199. So she qualifies as a farmer. So that's the first thing we've just established, that she does indeed qualify for the farm relief. Okay, so now this is the new element here, and this is worth dwelling on a little bit. Okay, so the benefit she receives consists of a mix of agricultural and non-agricultural assets, but there are some shared costs and shared consideration. Okay, so shared costs and shared consideration. Okay, and we need to essentially apportion each of those values between the agricultural and non-agricultural assets. The land mortgage doesn't need to be apportioned, it's absolutely 100% agricultural related, so there isn't a need to split the 80,000 between proportion relating to the holiday cottage and proportion relating to other assets. Okay, so in this next part I go through the apportionment procedure to get the shared costs and the shared consideration paid by Kate. So we've got costs to split up, and we've also got consideration to split up, and you can see in my solution I look at proportion referring to agricultural assets and balance referring to non-agricultural assets. So with the cost, the total costs were 20,000, and we split them up in proportion. So the shared costs are 20,000, and the proportion going to the agricultural assets is the value of the agricultural assets over the market value of the entire benefit. So she's getting 1.6 million out of a benefit of 1.76 million. So that gives 18182 going to the agricultural assets, and then the balance goes to the non-agricultural. There's your 20,000 split up between proportion for agricultural and non-agricultural. So it's worth just looking at this. So the total was 20,000. The agricultural assets included in the benefit were 1.6 million. The total benefit was 1.76. So notice now we're not looking at these totals up here. We're looking at the agricultural benefit over the entire benefit. It just so happens that the agricultural benefit is this value here. But do be careful that you don't use numbers that are up here automatically, because these numbers, in particular the total column, includes assets that she already owns. It's 1.6 over 1.76. And a similar consideration applies for the money that she pays to William. So she pays 300,000 to William, and you're going to have shared consideration, 300,000 by agricultural over market value. So shared consideration by agricultural over market value is working out as this number here. So 272,727 goes to the agricultural benefit, and the rest goes to the other. There's your 300,000 in total. Now, once we've done that apportionment, we can then use these values in the determination of assessable value. So we have to figure out the value of the agricultural assets. Remember, the agricultural relief applies to those assets, and the value of the holiday cottage. So just going down to the next step. So the agricultural benefit was 1.6 million. We deduct a straight 90%, as you've seen before. So that leaves 160,000. Now we then deduct the liabilities, costs and expenses. Now there are two elements here. There's the mortgage, which is 80,000, and that entirely relates to the land. So we get 10% of 80,000. And then 10% of this 18182. Okay, the calculation here is essentially 10%. I'm following the very strict process to determine these numbers, but if the deduction for agricultural relief is 90%, you're left with 10% down here. So 10% of 80 and 10% of 18182. So the encumbrance-free value is 150. And then for consideration, it's 10% of this number. This is the proportion related to agricultural assets. So 272723. Okay, and that gives a taxable value, excluding the small gift exemption, of 122,909. For the holiday home was a value of 160, and we deduct the full cost here. There's no 10% of costs here, and the full proportion of consideration, 27,273. Okay, so 130,909 is the benefit there, and 122 is the benefit for the agricultural. So now with those values, we can determine the tax arising. So Kate's agricultural assets 122, her non-agricultural assets 130, that gives 253. Gift exemption of 3,000. Now, point worth noting here, the threshold is 320,000, and this is despite the fact that Kate is not the daughter of Tim, she's the daughter-in-law, and daughters-in-law don't normally get the Group A threshold. But this is the consequence here. Kate steps into the shoes of Vincent, her deceased husband, and Vincent was the son of Tim, so she can claim a Group A threshold. Now, that's one of these tricky little things that you need to be conscious of, so just to give you a reference there. So group thresholds and stepping into the shoes of a deceased person is page 8 in the CAT manual. So special rule, so that the surviving spouse of a deceased spouse is deemed to stand in the shoes of the deceased spouse. So Kate pretends that she's Vincent. So a gift from the parents of the deceased spouse to his or her widow would attract the Group A threshold, because by pretending to be Vincent, she pretends to be the son of Tim. If it weren't the case that she was a widow, it would be a Group C benefit. And if she got a benefit from, say, a brother or sister of Tim, she would pretend to be their brother or sister. So this improves the group threshold that is available to Kate. So 320,000 is the threshold, and therefore there's no tax arising on Kate because the total benefit is under the threshold. She had no prior benefits. Okay, so that's the solution to Tim and Kate, and as I say, I've stripped away the calculation of the tax payable by William, so you can assume that that is not going to be an issue in the